Thank you, Peter, for the introduction. I do enjoy coming to Frankfurt in August after teaching all summer, but the last 2 years were very different in that respect. Hopefully this is the last one of those years. Hello, everyone, and thank you very much to the organizers and the reviewers for the opportunity to present this work here. This is a joint work with Konstantin, Sokolov, and Eduard Yelagin, who are both at the University of Memphis. And this is a very, very new paper. This is the first time I am presenting it, and I think this is the first time it's being presented outside of the University of Memphis Brown Bag seminar. So we are very excited to hear your comments and questions, and particularly for Mehrdad's comments. And thank you in advance for that discussion. So what we're trying to understand in this paper is a rather big question, and the question of whether innovative activities of stock exchanges are generally beneficial or perhaps not so beneficial for liquidity and other important aspects of market quality that we all care about. I think everyone in this room at some point has thought about these issues, whether the enormous technological progress that this industry has made over the past decade or more has generally been beneficial to market participants. And many of us have done research on these issues. There are several theory models that try to get at these, at the net effects of technological innovation. And there is certainly no lack of empirical studies that look at individual examples of innovation and try to understand what impact they have on liquidity, price efficiency, perhaps even welfare. What Konstantin, Eduard, and I thought the literature may still be lacking is a larger, more holistic picture of how innovation affects markets over a very long period of time. And But the reason, of course, that we don't have that picture, not necessarily have a full picture of that yet, is because it's very difficult to get a sample of such technological innovation that can be traced for multiple years, and the effect of which can be traced for multiple years. So the main contribution here, and this was Konstantin's idea about a year or so ago, is to find something that will correlate with exchange innovation over a long sample period and see how that something affects liquidity and other issues that we usually care about. So I hope that I've sort of created enough mystery here to get you guys excited. Let me tell you actually what we do. So we look at 15 years of new technologies introduced by the stock exchanges in the US, and particularly technologies that exchanges decide to patent. So we have about 150 of patented new technologies. If you want to think about them as tweaks to the way exchange technology works, that is probably not a bad way to think about them. And once we've identified them, we ask, so what do they on average mean for liquidity, for price efficiency, for trading volumes, and other characteristics of market quality that we usually measure in our tests. So we have a lot of results, and I will slowly try to get through them in the 25 minutes that I've been given. But if you were to identify if you were to ask me to identify the main result, I would probably say that the main result is that for liquidity, and what we find is that, well, there are two aspects there. First of all, new exchange technology tends to result in lower trading costs for those who trade smaller amounts. Those of you who are in this literature and do these analyses yourselves regularly, you probably already know that I'm talking about effective spreads. So effective spreads decline after your average example of new exchange technology. And this is consistent throughout our sample period. But what we're also interested in is what happens to liquidity costs of larger market participants, because as we all know, effective spreads generally measure trading costs for those who trade small amounts. What happens to institutional trading costs, for example? And what we see is that generally they unfortunately increase pretty consistently throughout the sample period after exchanges introduce these new technologies that we're looking at. Like I said, we have many more additional results that I will get to in a minute. But before I do that, I wanted to give credit where credit is due and talk a little bit about what has already been done in this literature. So as many of you know, a lot has been done. It is very difficult to figure out when this literature begins, the literature that tries to understand the effects of technology on markets. But I think it may be useful just to go to the paper that we all know and love, the work by Thierry Hendershot, Charles Jones, and Albert Menkveld in 2011, where they look at what happens to liquidity on the NYSE when the NYSE introduces new technology that helps basically market makers. Not only does it help the market makers, but also introduces some competition to market making on the NYSE. And as you probably all remember, the result there is that, of course, liquidity improves as a result of this new technology. The technology is called auto quote. And the patent associated with that technology is actually a part of our sample. But at the same time, in the same year, Thierry Hendershot and Pamela Moulton published another study that looks at another example of exchange technology, new exchange technology, or a new setup, if you will, also on the NYSE, called the NYSE hybrid. And they find that liquidity deteriorates as a result of the hybrid. And the reason for that, of course, is that the hybrid generally assisted those who take liquidity more so than those who make liquidity. So these results are rather expected. And there are in this literature multiple examples of such individual examples of technological progress. And the results, of course, vary by example. So if we know that co-location generally benefits liquidity, but then we also know that continuous trading doesn't necessarily benefit liquidity, and so on and so forth. So the empirics have done a lot, but it is not exactly clear where that generalizable result is, at least yet. And then a little bit more recently, there's been a lot of very interesting theory research on these issues as well. And again, as many of you know, theory generally finds that it really depends on what the model cares about. New technology may benefit markets. It may not benefit markets. It really depends on how the model is set up and what assumptions are made. So, like I mentioned earlier, Konstantin, Eduard, and I, for quite some time, thought, what can we do to understand this issue in a more holistic way, on a bigger scale? And we ended up looking at these US exchange patent filings and what happens after those. So as I promised, there is an expanded set of results, and there's quite a few things that we do here. So I color-coded them into blue, which is generally things that we like to see, and red, which is generally what we may not necessarily be super excited about. So let me start with the good things. So as I mentioned earlier, trading costs as measured by effective spreads decline as a result of new technologies introduced by exchanges. We, of course, can do the usual decomposition of effective spreads where we separate the costs to adverse selection of liquidity provider costs from everything else. We find that new technology actually helps on both fronts. So adverse selection of liquidity provider quotes decreases as a result of new technology being introduced. And then also the realized spreads decrease. We, of course, understand that the realized spreads are a composite metric that captures both order processing and inventory costs, as well as the profits of the market makers. So we can't necessarily say which one of those three declines as a result of exchange innovation. What we see is that something declines, or on net that they decline. But there is certainly reasons to believe that all three of those may be declining. But the big result here, of course, is the effective spreads are down quite substantially. I'll talk about the economics significance of all of this in just a couple of minutes. But for now, let me just say quite substantially as a result of these new technologies introduced by stock exchanges. And of course, as a theorist, and probably most empiricists would expect, trading volume volume increases after these new technologies are introduced. And again, this is what we would expect probably because trading costs decline. What we also find is that price efficiency improves. This is important, and these results are also very strong. Volatility declines, also a good thing. This is where, for now, the good things end, and we move on to what happens to institutional trading costs and volume. So as I mentioned earlier, institutional trading costs unfortunately increase, and institutional trading volume also unfortunately declines. So there is this dual effect of innovation, it seems. When it comes to small traders, things get better. When it comes to larger traders, at least from what we can see, things do not necessarily get better. So this is the majority of the results here. Now let me talk about our data and samples. So as I mentioned, this is almost a 15-year sample that starts in 2003 and goes all the way through almost all the way through 2017. We look at a pretty sizable sample of securities, 900 of those, and these are basically the largest 900 stocks listed on the NYSE, NASDAQ, and Amex that survived through the entire sample period. Our data sources are relatively generic, aside from the source of patent activity itself. So we look at the public depository of patents that's maintained by Google and basically select from there the patents that are filed by the stock exchanges in the US. And again, as I mentioned earlier, the rest is relatively generic. There is TAC data, there is Able-Noser data for institutional trading and trading costs. And we also do a difference in differences analysis, which I will get to again in a couple of minutes. And to do that, we need a control sample. And as you can imagine, there is no control sample from the US because innovation happens to all stocks at once. So we have to go to Canada for that. And we use Canadian Financial Markets Research Center's data. Unfortunately, these data are daily, so think of it as CRISP level kind of stuff. So I will talk to in just a couple of minutes about how we go about comparing these two samples. Now, I did mention that our patents are generally technological in a sense that these are relatively incremental tweaks to current exchange technology. So let me just give you two examples. One of the examples is the NYSE patent that talks about technology for high performance data streaming. So this is clearly important to those who trade at relatively high speeds and frequencies. There's also a NASDAQ patent in our sample that introduces a tracking apparatus that improves the latency of message processing. Again, something that a fast trader would probably care about. The vast majority of these are patents that care about speed and efficiency of information processing. And the reason I keep calling them relatively small tweaks is because I want to get this point across that these are not those fundamentally enormous changes to markets that these patents capture. There is, for example, no patent for the introduction of co-location, because that's not necessarily patentable. What is patentable, however, is technologies or small changes to technologies of the exchange that allow for co-location to run more efficiently. So this is what we see, but we do not necessarily see the big introductions of very large seismic changes, such as, for example, co-location. So how do we do it? We run, this is of course an event study, right? An event study around introductions of these new technologies. And we look at relatively long event study windows here because we want the markets to find a new equilibrium around these new technologies. And particularly, we want to give institutions enough time to have reacted to the new technology. So our main event window is 9 months long. In the robustness section of the paper, we actually work very hard to shrink this event window quite a bit to see if there is any difference for short-term changes versus these relatively long-term changes. And there's virtually no differences there. But one thing here to realize, and I saw that Jim Angel was here in the audience earlier, and he, of course, has a very famous study with Laurier Harris and Chester Spat about this. One thing to worry about here is that there is just a long-term trend of declining trading costs and increasing volume in the US markets that we, of course, have to control for. So we do that by detrending everything, every variable that we use in a very crude and simple way by using the equation that you can see on your screens and using the residuals from that equation for everything. So just to give you an example of what the detrended data look like, this picture here is the effective spreads from 2003 through the early 2017. As you can probably imagine, if you look at the raw data for effective spreads, you will see there's a decline during this sample period. But once we've detrended it, you can probably see here there is no, the trend is gone. So we are looking at detrended data when we are running our event studies. So let me show you a very quick picture of an event study that we run. This is, again, effective spreads before new technology is introduced and after. You can probably see here that effective spreads decline, as I mentioned earlier. And this is, of course, just a univariate result. I will, now that I've shown you a picture, I will switch to regressions from here on that, of course, will control for variables that we usually care about in settings like this. So our typical regression is our multiple dependent variables regressed on the post-innovation dummy and controls for volume and volatility, which again is typical in this literature. I will again admit that these are not diff and diffs. These are just regular event studies. We do worry about the fact that this is not against a control sample. So on the next slide, I will show you our diff and diff results for the Canadian controls. But for now, this is just the US. And as you can see, quoted spreads, effective spreads, price impacts, realized spreads, everything declines in the post-innovation period. Now, this is a regression that uses standardized variables. So the economic interpretation of it is not in the coefficients, but rather in what I'm about to say. And what I'm about to say is just to give you one example. So again, I'm going to stick to the effective spreads, and I'm going to tell you that the economic magnitude of the reductions in effective spreads is about 0.05 basis points per patent, or per tweak, or per innovation, whatever you want to call it. Now, you might be wondering, is that a big deal? 0.05 basis points, how big of a deal is that? Well, the way I'm thinking about it is if you take all the patents in our sample and sort of cumulate their effect, they're actually responsible for one half of the decline in effective spreads during this entire sample period. Now, I don't want to be definitive here and say exchange technology is responsible for one half of all improvements in liquidity, because of course there's countervailing effects here, right? There's some patents, maybe, I apologize for my cat, but some new technologies may be moving patents in the opposite direction. But on average, all of this innovation seems to be associated with one half of the decline in effective spreads that we observed during the sample period. All right, as promised, here is a diff and diff. As I mentioned, we did want to do it, but unfortunately we don't have access to intraday Canadian data for this entire sample period. So we had to resort to what we have, which is low frequency spread metrics. And we use the ones that the literature has generally found to work. I think the latest study on this is actually Abdi and Ronaldo, where they show that end of day quoted spreads is the best low frequency liquidity metric, especially when you're doing time series analyses like the ones that we are looking at here. And we also, so we use the end of day quoted spreads, and then we also use Corwin-Schultz effective spreads and Abdi and Ronaldo's effective spreads as well. And as you can see here in the diff and diff setting, and this is the most conservative diff and diff setting out of the two that are usually used for these purposes, you can see that the results are the same generally, that quoted spreads and effective spread decline after US exchanges innovate as compared to what happens to Canadian stocks trading in Canada. Let me talk about volume and volatility now. So, of course, exchanges derive a lot of their revenue and profit from trading volume. And it would surprise no one, I think, that new technologies introduced by exchanges result in greater trading volume. But from the standpoint of our theory models, of course, it also is important to mention that this makes complete sense in the sense that given that innovation results in lower trading costs, you would expect more market participants to come to the market and exchange assets. And this is exactly what we see. What we also see is volatility declines after these new technologies are introduced. So generally, good results on both sides. We also can run this through the Canadian diff and diff, and the results are very similar here as well. So let's switch to institutional trading costs. As you know, there is an ongoing and probably never-ending debate about whether institutional investors benefit from modern market structure as much as, let's say, retail investors are believed to benefit from it. And we hope that we can contribute to this debate a little bit by showing some numbers. So what we do is we compute, again, very conventional execution shortfall metric that is used in the literature to understand institutional trading costs. And of course, institutional volume we can observe from Abel-Noser. And what we find, and what you can probably see on your screens here, is that institutional trading costs increase and institutional trading volume declines after your typical new technology introduced by the stock exchanges. Now, I have to mention here the economic magnitudes again. So you probably remember that in terms of magnitudes, the reductions in effective spreads were 0.05 basis points per patent. Here we have increases in execution shortfall by 0.01 basis points per patent. So the magnitude is smaller than that of the reduction in effective spreads, but it's still there. Another way to think about it is the overall increase in institutional trading costs that we observe is about 11% of your average execution shortfall during this sample period. So it's not negligible, but in terms of magnitude, it's a little bit lower than that of the improvements in effective spreads. I have kind of lost track of time a little bit, so I'm hoping I'm not running out of time. Peter?
You're okay. You're okay. You have, let me check, well, 3 more minutes.
Oh, good. I only need 2 more minutes. Good. Okay. So we look at 2 more things, basically. We also try to understand price efficiency, and these are new results, and we are very thankful to Mehrdad for letting us actually put these in the paper. And price efficiency improves. So we measure it through 3, again, conventional metrics: the variance ratios, return autocorrelations, price delays. All 3 of them decline, which is a good thing, at relatively short horizons, right? So when it comes to longer horizons of measurement, the declines are quite a bit more subdued. And again, this makes sense because most new technology, of course, is focusing on increasing the speeds, and that's where you get short-term price efficiency improvements. One last thing I was hoping to show is the results in the cross-section. So I mentioned to you guys earlier that we have 900 stocks in the sample. So it's reasonable to suspect that there will be differences across those. So we divide them into 3 groups: the largest 300, the medium, and the smallest 300. We actually find that there isn't that much of a difference between them. So just to give you an idea, if you look at this first column here, the effective spread, the way this regression is run is these interaction coefficients for the medium and large stocks are the add-on effects to the main effect, which is captured by this post coefficient. So basically think of these numbers as, are the results for the medium and large stocks different from those for the small stocks? And as you can see, they're not. So for the small stocks and also for the medium and large stocks, effective spreads seem to decline by the same amount, or at least statistically indistinguishable amounts. There's some nuances in these results. For example, you can probably see here that execution shortfall doesn't seem to statistically significantly increase for the small stocks, but it does for the medium and large stocks. we are very careful interpreting these because it could be the power issue. Those of you who have worked with able nosor data, you probably realize that execution shortfall metric is a relatively volatile metric. And when it comes to small stocks, it is more volatile than it is for the large stocks. So we are careful interpreting this. But overall, as a big picture across all of these metrics that we're looking at, it seems that new technology affects the entire sample relatively similarly. So this is probably a good time for me to conclude. As I keep telling you, we look at a long-term sample of new technologies introduced by the US exchanges. We find that generally there is a lot of good things that happen afterwards, reductions in trading costs for small investors, improvements in price efficiency, greater volumes, but it doesn't seem that institutional investors are able to benefit from these new technologies to the same degree as those investors who trade relatively small amount. And we do quite a bit of discussion of this in the paper, and I was hoping to take a minute to mention this here. So as you know, the US market is ever evolving. And I mean, all markets are ever evolving, but the US one is probably one of the busiest. And the US market has introduced quite a few new exchanges over the past several years. The latest example, I think, well, one of the latest examples rather, is the members exchange, the MEMEX. And many of us may have thought, well, what is the point? And it seems, just based on our results, that there may actually be a point to all this, because the incumbent exchanges in their evolution seem to benefit one corner of the market and not so much the other. So it probably makes sense for those who belong to the other corner to seek alternative ways of exchanging assets, which these new markets could as well be. So thank you again very much for the opportunity to present here, and I look forward to Mehrdad's comments.
Well, again, thanks so much for having me discuss this paper. I'm Mehrdad, and I've recently moved to the Fed, so the usual disclaimer applies. Now, living in Washington, D.C., I've come to learn that these impromptu street concerts around metro stations are commonplace, so I'm hoping the noise from my window isn't too bad for you. But as I anticipated, Andriy did a great job presenting, so I'm only going to spend one slide on summarizing the paper. So in order to understand the impact of technological innovation on market quality, the literature typically examines the effect of a specific type of technological change, such as co-location or other types of exchange upgrades. This paper takes an entirely different approach and asks, what is the net effect of exchange innovation? Innovation is measured as the number of patents filed by US stock exchanges, and consistent with most of the previous literature, the paper finds that spreads and price efficiency improve. However, a finding that's not as well documented is that institutional trading costs actually increase while institutional volumes decline. So, I mean, this raises the bigger question of who really benefits from exchange innovation. You know, after giving the paper a close read, I really did enjoy reading it and thinking more deeply about it, because I think at the end of the day, it's a novel take on a really big question. I think our Zoom chat just lighting up right now, I think that would suggest as much. I think ultimately we want to better understand whether private and social incentives for innovation are well aligned. Now, if we look back in time, much of the innovation in US trading has been in response to regulation, such as the order handling rules and regulation NMS. And relatedly, a question arises of whether regulators should be technology neutral. So the SEC understandably has been interested in this question for some time now. So my discussion is really going to focus on methodology, having looked at the data a bit myself, because I think the question, is certainly worthy. Now, taking a step back first, there's been over 60 definitions of innovation in the literature. So the question becomes, what do we mean by innovation? The main definition on Wikipedia is the practical implementation of ideas that result in the introduction of new goods or services, or improvement in offering goods or services. Now, the literature acknowledges that patents are an imperfect measure of innovation for a number of reasons. For example, innovation can also take place outside of the patent system. And you can, if you use the citation data, you can get truncation bias if you're looking at patent citations, which the authors don't do. But patents nonetheless are widely used to measure innovation. And while the motivation of the paper is really about trading technology, when you actually look at the data, the types of patents that exchanges file are actually pretty broad in practice. There's been patents filed by securities exchanges for things like new auction mechanisms, new traded securities. So these are two topics I'll come back to in a bit. But the first thing I wanted to sort of, ask openly or think about was the sample period starts in 2003, and it spans a period over which institutional trading costs are relatively flat. This is, a fact that the paper uses as motivation. Now, I wonder what would happen if we extended the sample period as far back as the Abel-Noser data as reliable. And based on most accounts, I think it's 1999. And we have Jim in the audience. Jim, Larry, and Chester have shown, at least towards the beginning of that sample, where Abel-Noser, we can actually rely on it, significant declines in institutional trading costs just prior to 2003. So one thing we can say is perhaps this is all being driven by decimalization, but we've had other work out there that's confirmed it's not really driven by decimalization. Rather, most accounts would say it's given the rise of electronic trading. So according to the literature, we may even see even more declines if we went further back than 1999, because there were some other changes in market structure. And for perspective, in terms of how it relates to the patent data, there were over 80 patents filed during the 1999 through 2002 period, several relating to electronic trading. So I wonder, I'm really agnostic about this. I wonder if the paper should be extending the sample period back to extend this. But then alternatively, on the other hand, should we exploit the timing of when the exchange is demutualized and look at it sort of pre-post, both with regard to examining the type of innovation that the exchanges do and its impact on market quality. So coming back to the list of patents, this is some example patents I had found on Google Patents. And as I mentioned before, there are some patents filed for trading mechanisms such as opening and closing auctions. So two in particular I saw were NASDAQ patents filed by Frank Hathaway himself. He was the chief economist at the time. And I remember at a discussion at some FINRA conference when they actually looked at the data for the closing auction, and specifically, they found that the closing auction significantly decreased seasoned equity offering or SEO underpricing. Now, Terry and Carol have some work showing that SEO underpricing has been shown to be pretty strongly related to institutional trading cost. But then when you look at the figures, looking across all stocks, it's not as clear that you have a decline in institutional trading costs as a result of this. But this really led me to my next suggestion, especially towards the beginning of the sample. What we know is that, at least towards the beginning of the sample, especially in the case of the NYSE, the listed exchange dominated most of trading. So I wonder, in order to get some sharper estimates, at least towards the beginning of the sample, whether we should only consider NASDAQ listed stocks for NASDAQ innovation and NYSE listed stocks for NYSE innovation. So coming back to the patent data one more time, I also saw a number of patents for new traded securities, which is going to raise my next point. And I think maybe it's beyond the scope of the paper, but I mean, something worth discussing out loud. So, while the paper examines the effect of exchange innovation on trading costs, we know, at least historically, that securities exchanges have innovated in a number of ways that have contributed to market completeness in the error sense, like facilitating risk transfer and things like risk management. So it really begs the question of what is the set of relevant outcomes when we're trying to understand who benefits from security exchange innovation. And there have been some papers that examine some of these alternative outcomes. For example, I know there's a paper looking at the introduction of derivative contracts, and they use balance sheet data on corporate finance outcomes to see, what improved risk management has in terms of the operations and the investment of the firm. Another thing that came up when I was sort of playing around with the data and searching on my own, there was some trading-related patent filings by firms whose cash flows may be more closely linked with institutional investors, such as ATSs and institutional brokers. And that raises a question, which again, I'm pretty agnostic about, of where exactly we should draw the line when measuring innovation in stock market trading. Should it just be the formal exchanges, or should it be the sum of all trading venues and, the entire life cycle of an order, perhaps? But, again, all in all, I think it's a really important question and a big question and an entirely novel take on it. And I'm looking forward to seeing the next draft of this paper. Thank you.